Hello and welcome to Money Life. This is Sucheta Dalal. This week we are naturally talking about Jane Street and SEBI's sensational order. On 3rd July, the Indian Capital Market Regulator, the Securities and Exchange Board of India, created a storm in the market early in the morning. In the most stringent action ever against a foreign trading firm, it barred Jane Street, a formidable US based proprietary trading powerhouse from the Indian markets, with an interim order. The 105-page document, issued after an 18-month investigation, revealed the kind of manipulation that Jane Street was apparently doing. Operating through multiple entities, it seems to have had a two-pronged strategy that could rig up prices and dump stocks and extract spectacular profits. The numbers and scale is stunning. SEBI says between Jan 2023 and March 2025, Jane Street earned 43,289 crore in profits from index options, and in that period lost only 7,687 crore. This is its stock futures, index futures, and cash trades. That itself tells you a story. The imbalance, it says, reflected a strategy of profiting by orchestrating index moves to mislead other market participants. SEBI has impounded 4,843 crore, nearly 5,000 crore, of what it calls unlawful gains by Jane Street. Jane Street has, of course, disputed SEBI's findings and says that it intends further engagement with the regulator. To my mind, this is a rather restrained response. Doesn't matter that a few more comments have come out since then. Given that this is the first time that Jane Street has been accused of market manipulation in any of the 45 countries in which it operates. SEBI action is undeniably bold, it's huge, and it's been discussed the world over. The order seems detailed and convincing, but it also raises several uncomfortable questions. The two key ones are: was Jane Street able to manipulate Indian markets because of low liquidity and shallow depth? Second, are Indian surveillance tools and regulatory framework lagging behind the complexity that is required in today's high-frequency trading and artificial intelligence-driven algorithms? Now, to some of us, the feeling is very uncomfortably familiar. In June 2015, I published a whistleblower letter exposing the co-location scandal at the National Stock Exchange. I got sued for 100 crores by the National Stock Exchange, but we were proven right. The colo scandal was about select firms exploiting privileged access to servers and profit from them. It was believed happened because of collusion with NSE officials. Now, they are able to hit those servers milliseconds or nanoseconds faster, and of course profit, because whoever hits the server first gets to make more profits. A decade later, this investigation is still continuing, hasn't been wound up. SEBI is now discussing a settlement with the NSE, literally as a gun to its head, in order to clear its IPO. I just talked about it in a video blog last week, if you would like to look at it. Worse, SEBI has been unable to prove collusion by NSE employees. It has served notices only to 3 brokers, and action is going on. There are orders as well. And it's looking at, like I said, a settlement. So all these investigations and some show cause notices that it has issued seem to have vanished into thin air because there's no follow-up action, and it'll all probably be wound up in the settlement very unfairly. Look again at our articles that I've linked here. This time is completely different. The manipulation took a different form. It's about expiry day price swings rather than server latency. But the core problem remains: a market structure that creates an irresistible incentive to game the system. This is only an interim order. If SEBI's follow-up investigation takes as long, 4 years for NSE's first show cause notices, then Chairman Tuhin Kanta Pandey's assertion that market manipulation will not be tolerated is going to sound rather hollow, as is his belief that it's only a surveillance issue. It's not. But surveillance also is a problem which shouldn't have been there. There is a crucial difference between the two cases. In the NSE colo case, SEBI was reluctant to investigate potential collusion, systemic failure, and governance issues within the exchange because the NSE was too big and powerful, and SEBI was like a captured regulator. In contrast, this time, SEBI has been bold. It has started the investigation itself, issued a warning to uh, Jane Street in February 2025 through the NSE. It asked it to stop its alleged disputed practices. And when Jane Street apparently persisted, SEBI has acted very decisively. So, what was Jane Street's strategy? Apparently, it was hidden in plain sight. SEBI's allegation is that it followed a two-act pattern. In the first phase, it alleged that Jane Street made aggressive purchases on cash and futures markets to drive the Bank Nifty index higher. Retail traders looked at this as a bullish momentum and rushed into call options. Meanwhile, Jane Street was quietly buying puts and selling calls at attractive prices because everybody else was thinking there's an upward momentum. It alone knew that it will unwind its cash and futures later and cause a fall in prices. In the second act, in a precisely engineered action, it would dump its long positions to send the Bank Nifty crashing while locking profits on the options. On expiry days, Jane Street's index option volume was apparently as high as 350 times the cash market turnover in underlying stocks. In major stocks like Kotak Bank and ICICI Bank, its expiry day trades accounted for almost a quarter of total volumes. On 17 Jan 2024 alone, says the SEBI order, the firm booked 778 crores in option profits on one single day while incurring a small loss to set up the trade. How is this even possible? Because derivatives in India have become the main act rather than a hedge for underlying cash market positions. Bank Nifty volumes dwarf the combined turnover of all the underlying stocks in that index. On some expiry days, notional options trading is nearly 100 times the cash market transactions. Nobody bothers. Why? Because the government earns hefty tax revenues from this frothy turnover. SEBI earns fees, but the imbalance hides a rather shallow, fragile market that is ripe for manipulation. And this is what SEBI says has happened now. Was it not anticipated? Ironically enough, it was seen decades ago. In 2005, Dr. R.H. Patil, who's considered the founding architect of the NSE, had anticipated this. He said individual stocks and leveraged derivatives invite manipulation. In fact, his speech, and I'm going to quote from it, said, "The world over, stock futures are not favored in view of the risks that they pose to investors and also to markets. Futures in individual stocks are considered to be highly risky, primarily because they can be manipulated by unscrupulous speculators. A large group of speculators can come together and manipulate the future prices by acting in a concerted fashion. Since a trader in futures has to shell out only margin amounts and not the full price of the value of the contract, leveraging becomes easy." End of quote. Back then, Dr. Patil had argued that index futures were relatively safe. 2 decades later, SEBI's order suggests that even index derivatives have become highly vulnerable. So we now come to the question of why India? Why did Jane Street do this in India? I think most of you already know the answer. So first, Jane Street was founded in 2000, is among the world's top quant trading firms. Its Indian operations are enormous through multiple entities, some of them in Singapore. Its Indian operations are so big that it accounts for 10% of Jane Street's global profits. So make no mistake, India is very important to Jane Street. Jane Street has never faced manipulation charges in New York, London, Singapore, and other developed markets where it operates. Why is this? Why do you think this happens? Is it because those markets have deeper liquidity, making it harder for a single entity to move prices? Most likely. Or is it because the regulators in those countries have invested in far more sophisticated real-time cross-market surveillance and machine learning tools that flag such anomalies before they spiral into the sort of manipulation that SEBI is accusing it of? Even this is possible. In fact, this is underscored by the SEBI chairman's recent statement that it's about surveillance and SEBI is going to invest more in surveillance technologies. SEBI collects huge fees, so this is rather strange. I have written before in 2023 that SEBI's annual reports since 2020-21 have repeatedly made serious claims. In fact, I call it a boast about its surveillance department using machine learning, AI, deeply integrated technology to unearth complex modus operandi with adoption of better technology and data analytics. So the annual report is telling us about data lakes and this and that. And now suddenly we are told we need to invest huge amounts for surveillance technology. Shouldn't that have been the main focus? This is a question that I raised during the Adani investigation. And it's a question now SEBI is raising during the Jane Street investigation. Perhaps these tools exist and they enable SEBI to reconstruct Jane Street's trades post facto. But what is important is to detect manipulative strategies in real time when they are happening, not post facto. In fact, it is widely believed, while we congratulate SEBI for it's done, it is widely believed that SEBI's investigation was not triggered by anything that it's noticed in its surveillance systems. Doesn't matter that questions were being asked about sudden and unexplained price movements. In fact, people think that Jane Street's lawsuit against Millennium Management in April 2024, where it alleged that two former traders working with it stole a confidential strategy that had generated $1 billion in profits in India alone in 2023. That court case revealed how lucrative India was for Jane Street and probably for many others, and how they could extract such massive profits through algo strategies. It was a wake up call. Lots of people asked this question at that time. It's a good thing that SEBI acted and started an investigation and come up with it. The question now is burden of proof. The burden of proof for market manipulation is high. Having taken on a large US firm and being watched by securities regulators and traders from around the world and other jurisdictions, SEBI has a lot at stake. It must show that the trades were designed to create artificial price movements rather than being just aggressive bets. And it has to conclude this investigation quickly, issue a final order that holds up to legal challenges. Remember, the best legal minds in the world will be on Jane Street's side. And SEBI has conducted itself pretty embarrassingly where the Colo scandal is concerned. At the same time, SEBI needs to examine the structural weaknesses revealed by Jane Street's manipulation, not about surveillance alone. Should India continue with weekly expiry days, which compress volatility into predictable windows? Does the sheer volume of derivatives relative to cash trades compromise market integrity? Should position limits or higher margins be imposed to curb speculation? SEBI has been talking about all of this, so it's aware that there is an issue. Who takes the hit? Retail traders. They are the collateral damage. A lot of index option volumes in India are driven by individual traders, most of them using off the shelf algorithms. SEBI's own data has shown that 90% of them lose money. These traders act in the belief that an index reflects natural movement of the underlying stocks, where in fact SEBI's findings are showing that a single investor is able to control both the index as well as the underlying market at will. This can only happen when the market lacks depth and liquidity. In the US, retail traders have flocked to options too, but the risks are magnified in India by thinner liquidity and weak market infrastructure. Unless things change, traders will remain at the mercy of sophisticated players who can orchestrate volatility for abnormal gains. We have no sympathy for retail traders because we see them as gambling, but this is unfair. This cannot happen in a regulated market. To its credit, SEBI has shown the courage to act, unlike in the NSE Colo saga, where it appeared reluctant and defensive. But the bigger challenge is to build market architecture that is harder to game by any one entity, or next time it may be a few large entities acting in concert. Why not? If there are such huge profits to be made, this too can happen, and they can act by diffusing volatility, and SEBI needs to have tighter position limits, higher margins for expiry day trades, and build depth. Without these, India's derivatives market will remain a soft and tempting target for big players to test their strategies. Ensuring this may require willingness to sacrifice trading volumes, a willingness on the part of the NSC, which is just about to list. It will not want lower trading volumes because it means lower profits. The government has to sacrifice the taxes that it earns because lower volumes means lower securities transaction tax. But the larger picture and what it needs to look at is a market that's fair, liquid, and resilient. Is that where we'll move? It'll be interesting to see how this investigation progresses. At the moment, we are proud of what SEBI does, but we are scared about whether it's going to be able to make its case. Do you agree? If you do, please subscribe and share this video. Thank you.